Welcome to TheoTrade. This is Don Kaufman. It's April 14th, 2023. We are just about an hour after the cash close here on this Friday afternoon. Of course, the S&P's massively unchanged in today's trade. All right, there was some volatility on an intraday basis, but tell you what, the last 9 trading sessions have, well, left me wanting more. And of course, asking the question, when the market music stops, is this going to be a meltdown? We're going to cover that and much more here on this weekend's update. Let's jump right to the S&Ps. Before we even look at any of the bullets on here, I want to talk about some of the levels specifically in the S&Ps, because I've made quite a number of statements that right now it's less about, if you will, being bullish or bearish. Look, we have seen throughout the course of this year and last year an incredible amount of what we term one-sided trade. Markets are just as manic as people have been lately. And when I start talking about one-sided trade, for this example, let's cruise over to the spiders, right? And I've just been, relentless discussing this. I'm actually going to pull up a 3-year chart and really kind of zoom us into, if you will, most of, when the volatility kind of kicked off in 2022 and to present time. When I'm talking about, manic and, if you will, one-sided trade, what I'm referencing in this case are, wild moves to the downside, wild moves to the upside, wild moves to the downside. Everything we've seen, okay, is incredibly, if you will, one-sided trade. And it doesn't matter at this point in my mind whether we're on a bullish run or a bearish run. I mean, look, on this most recent bullish run, which we're going to discuss here, volatility has gotten crushed and skew has actually come up, but interesting and then ironically, the same thing happened back here, okay, back here. And I am not at this point calling for a top, but there are challenges, if you will, with trading in an environment that is manic like this. It really is. It's challenging environment, because what do you do, okay, when the marketplace, has this relentless, look, people do not make charts like this. Only computers make chart like this. What I mean by that is this is just algorithmic order flow driving us. It's all one-sided trade. What do? You buy, you buy, you buy, you buy. On an intraday basis, it's, you can scalp this stuff, but when you're trying to position yourself and you're trying to sell premium, it's tough. And I'm going to explain exactly why it's tough. So how do you sell premium in a market that's straight up and has volatility, crushing down? Again, some of what we're going to be covering here on this weekend's update. So with that, let's jump back and let's talk about some specific levels. Because again, as I said to you, all that I see right now is us, if you will, pinging back and forth, okay, between levels. And by the way, putting this on a broader time frame sometimes does it a little bit more justice. When you look at this on like a 3-year time frame, you're like, yeah, it does. Because I know that everybody's like, it's a wicked rally right now. Really, it's a wicked rally? Okay, you zoom out for a second, you go, hey, there's no rally. This is a wicked rally. Like, that's just relentless. Now it's just, chop and slop. And that's it. And that's why I say, you have to remove yourself from what you see or think on a daily basis. And right now is one of those times where you say, you got to block out all the extraneous noise, right? There's just noise, because noise is like, CPI and PPI. Look, you have to know when those announcements are going to come out, because they're catalysts. You know that at any given point in time, this marketplace is just this pool of gasoline. And, every one of those announcements that comes out, whether it's CPI, whether it's PPI, or this morning, we had, retail sales, which undid some of the JP Morgan earnings. And again, it's just these sparks being, thrown at a pool of gasoline. Okay, so it's good to know what's coming out. It's not important to know the numbers though behind it. Okay, so with that being said, when you start looking, and I say at particular levels over here, All right. What is striking is that, again, we're pinging back and forth. And by that, I simply mean, let's look at start with a 30-day 1 hour. And when you look at the 30-day 1 hour, this is immediate. We're like, no, it's this magnificent rally. Okay. I would agree in the 30-day time frame. Then you look at it in the 180-day time frame and you go, no, there is no rally because we did this, we came back down here. We did this, we came back down here, we touched here. I mean, it's becoming almost comical at this point of pinging these levels. One of the levels that is critical, right, to the upside, and we saw this a tremendous amount, is this 42.11. Look, I'm not trying to handicap exactly, we're going to go to this level before this level. You have to be aware of exactly where they are, because when you don't have, a good feel for markets, and the markets itself is just a volatile slop fest, and that's kind of what I would term what we're in right now. Yes, it's a very professional term, a volatility slop fest. But you got this 42.11, you got a 41.06, and then you've got this 39.31. And these are levels, by the way, we've been pointing these out for weeks, for months, in some cases, years, like the 39.31 and the 42.11. This 41.06 is a little newer. And right now, we're kind of stuck between a rock and a hard place. And it's my belief, I think you kind of got to check the 42.11 box before going back to 41.06. But as I said on Wednesday night, if you actually break back below 41.06, you kind of fall into the abyss, because 39.31 it's a long way down. And that's one of the things I wanted to start with here, is just getting you acquainted with those three levels are the place to effectively start. Now, things that are getting a little weird. And that's why I say, there's like this market music, and I think the best synopsis I can give you isn't about market music. You're on right now a merry-go-round, of risks. And you have been now for the last few years. This summer, I anticipate, is going to be extremely volatile. And I'm going to come to that, because if I think that this summer is going to be volatile, do you think that I want to run out and I'm going to sell some puts right now? I don't really want to sell a tremendous amount of premium if I'm telling you that volatility is going to come back and it's going to haunt us, right? Because you're on this merry-go-round of risks. And right now you're like, it feels pretty good, man. Feels pretty good in the merry-go-round, till you actually turn the corner and you're like, here we go again. And then you're not on a merry-go-round. You actually realize that you're on a big, scary roller coaster. And those risks are coming back. Look, what you have right now, and this is not me saying this, this is, the Fed, you have a cooling economy. You have a cooling economy. And that's, everybody, well, how do we know it's cooling economy? CPI and PPI confirmed a cooling economy, which are deflationary, and they're bullish. And you go, well, why is that bullish? Because we're hooked on the juice. If you haven't looked lately, I'm just going to bring you to it. This is the CME, the Fed Fund Futures, right? Let's just clarify this very, very quickly. First of all, when it comes to Fed Fund Futures, what you're looking at right here is the May 3rd meeting. So what are we at? About 3 weeks away, just about 3 weeks away. Right now, there's approximately a 77% chance, of a quarter point hike. Right now, we're trading 475 at 500. That's the Fed Fund Futures. That basically means we're at 5% on the Fed Fund Futures. Ready? Time out. There's a 77% chance they're going to raise them by a quarter point. So we're going to go from 500 to 525. Got it? Get it? Good. What the market is actually doing, though, right now is when crappy, economic data comes out, bad economic data, they actually price in. They're like, well, what's bad economic data? For example, like retail sales today. If anybody missed retail sales, retail sales, big miss, big miss in retail sales. But when retail sales comes out and it's really, really crappy, you do realize that that's really, really good, because if you go out to the December is actually not only isn't it pricing us where we presently are. Remember, we're at 475, 500. Here's 475, 500. The probabilities actually show it's not just a rate decrease, a fairly significant decrease. So they're actually talking about cutting rates already when we haven't even stopped, the music for the rate increases. People, it's a huge like catch-22. We got some problems over here, right? Because what you're basically doing is you have a marketplace that's actually cheering. They're like, yeah, down with the economy, man. Because if it goes down with the economy, okay, what are they going to do? They're going to make cheap rates again. I'm going to tell you right now, my belief, and one of the reasons I think that we're going to have such a volatile summer. And again, this is the opinion piece, right? Okay, there's things that are fact in here and things that are opinion. The fact of the matter is you saw the probabilities in the Fed fund futures. Okay, that's just trades going through. You see, the fact is that CPI and PPI are basically saying, inflation is cooling to some degree. Till, of course, you actually include like oil, which just spiked back to 83, but that's enough of that. Okay, retail sales, though, are coming down. You have an economy that's actually cheering, okay, going off a cliff. You're like, yay, roller coaster off a cliff. And they're cheering it because they're hooked on the juice. You know, the opinion is this summer, the Fed's actually going to come out. I don't think they're going to be so likely to cut rates. I think they're actually going to be very steadfast because inflation is entrenched. Inflation's entrenched. It's going to take them longer than expected unless we completely fall off of a economic cliff, which could happen this summer because of, well, there's an economic cliff sitting in front of us with the debt ceiling, yada, yada, yada. Forget all that. There are so many issues, though, that are going to come to fruition this summer that we're going to have volatility. You know, like, I was going to go on vacation. Put all those on hold, okay? Or go on vacation. I live on vacation, but I have good internet connectivity. Nevertheless, okay, you got to expect it. I think the Fed is actually going to flip around and they're going to say, you know, forget, we're not going to be cutting rates. I think they're going to push rate cuts all the way into 2024. And I think that the marketplace is going to have a little bit of a spasm on that. It's one of the reasons I'm very apt not to sell a huge amount of premium. So cooling economy and deflation, how are those bullish? They're really not, okay? Retail sales, a big miss. Look, retail sales came out today. It was like a momentary lapse of reason. Look, this is retail sales. Oh, we're going down, okay? But when you start looking at some of the retail stocks out there, what are they? Right? You want to talk about Amazon? Nah, nobody cares about Amazon anymore because it's not retail. Right? They got the cloud, man. You look at stuff like Costco. Okay, Costco took a hit. What are the retails you got? You got Walmart. Oh, it's mild. I think it moved. That's the sign, right? All right, a little bit of Target, but it was negligible. Negligible moves on a big retail miss. Again, you have a marketplace right now. One of the biggest things that I want to clarify when I talk about the music stopping, it's going to be a meltdown. Push all of that aside for a second. Here's the key. Markets right now are completely detached, I should say, from reality. Okay, so it doesn't matter what you think is going on in the economy, right? We're just, driving forward at 100 miles an hour, looking through the rear view mirror. That's it. And that's what looking at like CPI and PPI happen to be. And all of a sudden, okay, when you're going 100 miles an hour, and driving, looking through the rear view mirror because you have no idea where you're going right now, okay, we're going to hit something and it's going to be big. Again, hands and feet inside of the vehicle at all times because we have a cooling economy, retail sales, a big mix, the dollar is getting annihilated. Okay, the dollar is pretty critical because the dollar actually cooling off initially is very bullish, I would indicate, for the marketplace, but dropping below like 100 could actually scare everybody. Right, things could get wild. You're going to have to watch the dollar trade in the days to come. We had bank earnings. How ironic that bank earnings, okay, look at this. JP Morgan, stellar, just absolutely stellar in bank earnings, which leads us to believe it's going to be okay, right? Everything's going to be okay at this point. Well, we're going to start to actually hear from the likes of tech as well. Meanwhile, Wells Fargo reversed off of what was decent earnings in the conference call. Citi, okay, maybe a little bit more mild, but then we still have to hear from the likes of Bank of America. You would think that Bank of America already had its earnings announcement. Clearly, it has not. Nevertheless, it's up like it did. So we're not through anything yet. All right. The other aspect that's really worth discussing right now is, high skew with low vol. So one of the things that's probably on a lot of people's minds is the VIX. The VIX has actually collapsed back down all the way into the 17 range. Now, I have to pull up a 3-year chart. Why? Because you got to go all the way back, okay, into 2021, right, to see volatility effectively this low. Look, this is absolutely unequivocally, it's the closing low for volatility, okay, in really, it's the last, you got to come all the way back here to the beginning of 2020, end of 2021. Well, this is like Christmas time, but you got to come back to right to the beginning of 2022. You're about 14 months removed from seeing volatility this low. Okay, but at the exact same time that volatility is low, to catch this, skew is actually amped up again. In fact, I'm going to put this into a what we term an area chart real quick. And I'm going to do this just to give you a quick feel. So for the first time in a very long time, all right, skew is actually starting to amp up again, which basically means out of the money puts, okay, are trading for a big premium versus out of the money calls. That's indicative of hedging activity. So it doesn't mean necessarily anybody's scared out there, because if somebody's scared, they'd be buying volatility, right? But they're not buying volatility right now. No, they're quietly going out there. They're buying way out of the money puts, and they're financing those by selling out of the money calls. So the VIX is not a clean way to actually access and dig into vol. Like, you really have to look specifically at things like skew, and skew tells a very different story. But the skew coming up actually gives us opportunities at trades like Christmas tree spreads. For those of you that don't remember the Christmas tree spread, remember this little monkey? Okay, the Christmas tree spread this is where the spiders are presently trading. If the marketplace, rallies, you get to keep, let's say in this case, it's about $800 of a credit. If the market rallies anywhere to the upside, you keep the 800. If the market heads down, you have this opportunity to make a windfall profitability of up to about $5,000. But if we crash, I mean fully crash below like 320, you could take a big loss. But what's cool about this trade is that you go, oh, I would never want to get killed to that amount. Yeah, but it's actually kind of cool because you can actually take the credit here and you can use part of your credit to go out and buy VIX call spreads to mitigate any of this downside exposure. So it's high time again, and I did not route any of those trades today. Again, I'll reference once again, skew jacked all the way today. It's actually one of the reasons I waited to record this video, because I wanted to see what the skew was again. Skew only calculates about an hour after the close. Skew jumped all the way to 134. It's actually the highest skew we've had, okay, in a year-to-date basis. In fact, if you go back to skew, and I'll open up like a 3-year of skew, you got to go back again into earlier 2022 to see skew this high. So it's very much in play. The Christmas tree spread and different types of skew trades are going to be in play right now, which is how we're going to sell premium. We're going to sell premium. Yeah, got to get a little cute, got to get a little smarter, right? But I want to go out there and I actually want to sell premium, and then I'm going to actually finance. Okay, by selling premium, I'm actually going to finance the purchase of some VIX call spreads. So it's on right now. I mean, look, I don't mind saying, like, I do believe the music's going to stop and there's going to be much more of a meltdown, because nothing that's going on, nothing that's transpiring right now is like, oh yeah, this is really going to be bullish. There's green shoots in this marketplace. Even after hearing like, JP Morgan's numbers and so forth, the only reason they're making money is they're taking it from the Fed, okay, and trying to basically, lay it off a little bit. They're actually playing the yield curve. I mean, everything they're doing right now is they're paying you next to nothing, okay, and just taking free money. That's it. That's the name of the game right now, is they can make, risk-free like 5%, pay you maybe 1%. It's gold, Jerry, it's gold. Some of you are starting to move to CDs and so forth, making forward 5%. And JP Morgan doesn't mind that either. But that's not really trading or earning a living. That's just called, a bank. Onward and upward, get your trade on this week's profit and losses. So I closed GLD trade. I had a bullish GLD trade. Closed that for about a 57% profitability. So about a 57% return on that on the GLD trade. I've actually closed several ES puts because we kind of rallied a little bit this week. So I closed some S&P puts. I had a NVDA spread fall flat on its face. Come on, everybody wants to hear, like, he always makes money. I didn't on NVIDIA. Okay, on NVIDIA, if you actually bring this one up, it's going to expire. It's worthless. You are worthless. You know what? At times like this, where I'm actually quite proud, that I was defined risk, okay, because I just got run over by a freight train named NVIDIA. So that's not gonna help me at all. It's this move right here that got me. We were good until that move, and it was all over. But the crying over there. But you know what? That's par for the course over there. So closing out GLD for over a 57% gain. Closed out the S&P puts, several S&P puts for over 50% gain. Lost 100% on the NVIDIA spread. which is a rare occurrence, but it happens. Okay. And I want to give you a little update on short calls. When I say an update on short calls, if you look right here on my monitor tab, look, I have been selling calls. Okay, selling calls in the S&Ps. I'm not losing money. And one of the things that's so important, people are like, you got to be getting killed. Look at those S&Ps. Well, let's go look at the S&Ps again. The S&Ps, they're straight up. They're not straight up because over the last, what, like 9-10 trading days, we've done nothing. I know we finished at the upper edge of the range, but whatever. We've done nothing. And guess what? Both of the calls that I've sold, okay, and this call was sold on what, March 30th. This one was sold on March 31st. Okay, they're basically, well, one's up 5%, the other one's up 26%. If I go over here to Tasty, by the way, I'm trading much more extensively now on Tasty than I am on Thinkorswim. You can look at QQQ. I'm short a 10 lot of calls in the Qs. I'm up 16%. I've got another 4650 call here. I'm up about 30%. Another short call. These are the 4475s. These have been on a while. They're down 30%. I got to tell you, for a rally like this, to be flat or up anything on those short calls is spectacular. Last but not least, in terms of get your trade on, I opened an XLY spread. XLY spread, for those of you that are unaware of what the XLY is, okay, it's basically an ETF for consumer discretionary. Anyway, in the XLY spread, here it is. In all of its glory, it's just an in-out spread. And the reason I wanted an in-out spread on here, I like the XLY. It's just chopping up and down, just chopping up and down. And I know that Amazon's going to have earnings. Amazon is a huge portion. It's like 22% of the XLY. And then another 16% of the XLY is actually Tesla. So they're going to have earnings in like the next couple of days. So I figured there's one of them has to miss. Just one of them has to miss the earnings, and it'll chop to the downside just a little bit. Enough where I'll have degrees of profitability inside the XLY. That was kind of my intent. By the way, I also shot out a mistake today. We made a mistake. I accidentally shot out the symbol XLK initially instead of XLY. If you're in the XLK trade, you're fine. Because I got to tell you what, it was kind of a mistake, but at the same time, the first trade that I was looking at was actually in the XLK. So it's called Get Your Trade On. I'm getting sloppy! But I actually ended up doing both the trades because I felt bad that I sent out the wrong symbol. So I ended up doing the other trade. And you can see there's another 2,500 contracts in here. So this is not dissimilar. It's some very chopped out trade. We're in good shape. This is going to have earnings as well. So we're gold, Jerry. We're gold. Whether you did XLY or XLK, yes, I updated that in here. By the way, as a trader, you learn after a lot of years in this business, if you screw up, take ownership of it. It's yours. Okay, I'm taking ownership, and not only did I take ownership, I actually put the trade on. Why? Because I have to. All right, the last thing we'll always love to cover here on the weekend update here is right here in the SPX, the mother of all products. One of the things that's been shocking in the SPX, you want to see an anomaly? I'm going to give you an anomaly, right? This week was a 4-day. This is 3 weeks ago. It's a 4-day trading week. It's when, we came into Good Friday. That week had about a $60 expected move. You realize we did nothing throughout the course of the week. We didn't hit the upper edge. We didn't hit the lower edge of the expected move. This past week that we just passed through, this one had a $75 expected move. Okay, what did we do this week? Nothing. Did we get close earlier today? We did. We did not hit the lower edge. We did not hit the upper edge. You're going to be hard pressed to find 2 consecutive weeks of not hitting the edge of the expected move. Meanwhile, this next week of trade, I already have the expected moves drawn over here. We're looking for plus or minus approximately $57.65. Look, stick a fork in us. We're going higher, we're going lower. This is actually one of the weeks where the short duration options, I might be a buyer of premium in the short duration. I may literally be buying options in the short duration, looking for an explosive move above and beyond $57. Okay, so I'm actually telling you something here in no uncertain terms. Look, okay, do I think that a market meltdown comes this next week? No, but we've got to be on the verge of much more considerable volatility. Not because the VIX came off, not because the bonds have actually started turning down. Okay, the simple fact is, the markets, they've been ignoring a whole lot of reality for a lot of time. And if the Fed is actually going to stave off traders a little bit, they're very likely to do it in this next week of trade before they go into their quiet period. So again, I'm less inclined to even look like, the calendar and so forth. There's lots of data okay, that's still going to be coming out, not nearly as much this next week, but the data that comes out, you got ECB minutes and so forth. We had Fed minutes this week that didn't say very much, but the data that comes out, every little nuance is another catalyst. It's not going to take much, but the marketplace, okay, could immediately get scared. If the market thinks the Fed is not going to cut rates in the second half of this year, S&Ps are going to get crushed. And that's actually the notion that I'm looking for here in the next few weeks. All it's going to take is one little Fed person saying we have no chance of actually cutting rates. Inflation is stubborn, okay? And markets are going to go for a ride. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.